War. What war?
All right, everyone. Let's get this going. Let's get the news flowing and let's get those portfolios growing. It's been a bloodbath in the stock market, but not for our viewers because we're going to try to cover everything you need to know. In focus tonight, Sudan's civil war is brewing. Since you probably won't see this on MSNBC, we'll fill everyone in. Sudan has been having increased tensions between the Sudanese Armed Forces and the Rapid Support Forces, a Sudanese paramilitary group. In recent days, these tensions have turned into skirmishes all across the capital. The U.S. evacuated their embassy, potentially anticipating the situation to escalate. What other players are there? As you probably guessed, the U.S. put the president in power. China's there, and the famous Russian PMC Wagner Group has been trying to open a naval base in Sudan for years. Now, without trying to sound like Alex Jones, the Alphabet Boys do always have perfect timing with things like this. Now, anytime you're analyzing geopolitics and a conflict starts to brew in a country, it's good to assess the underlying economy of said country to figure out what will be affected. For Sudan, their primary export is gold, with roughly half of their annual exports being this. Most of this gold actually is imported to the UAE. Additionally, the UAE's total gold reserves has increased 43% since August of last year, an interesting thing to note. Also, with Sudan being the 28th largest gold producer in the world, this likely won't have a sizable effect on the gold market. More on Marxism here, guys. That's right, M4 Army interest rates will be going up for those of you that were responsible and kept your credit score high. But is this really Marxism? That's for you to decide. Let me know what you think in the comments below. In my opinion, I think it's, you guessed it, the continued rise of the oligarchy, the decimation of the middle class. If we look at what's changing here, we see that a majority of home buyers are going to have an increase to their payments. Specifically, it will be home buyers who happen to have a credit score between 700 and 780, which just happens to be the majority of home buyers. Weird, huh? Go figure. It is about accumulating wealth, folks. So Fannie Mae is going to be bringing in the big bucks as a majority of home buyers will now have to pay more, while people with credit score below 680 will be paying slightly less than they were before. It is important to keep in mind that this is all relative, people. People with a credit score of 680 used to pay about 13 times as much as higher rated borrowers, and that will now be cut in half to about 7 times more in interest payments. Who doesn't see a raise in rates? People with a credit score above 780 or higher. Is that fair? Not sure. Does it make any sense? Absolutely not. Is it reflective of laissez-faire capitalism? Also no. Are banks pissed? You betcha. Are you? Only if you have a good credit score. Moving on to market events that happened today. Google and Microsoft both posted earnings yesterday after the bell, with both beating expectations nearly across the board. At face value, these are good earnings, but we have to look at them a little more in depth because we know these companies do their best to cook the books. If we take a closer look at the broader economic context, look at the fine print, and relate this to valuation metrics. For Google's case, their operating income, which is a company's income after all deductions of expenses, continues to slide, coming in at just $17.415 billion. While Google is undoubtedly a good company, they're showing a worrisome trend with this decreasing operating margin, which has continued to contribute to their lack of growth over the last year. Now, let me ask you guys this question. Does this chart look like a company whose revenues, operating margins, and profits are growing, justifying higher price targets? You tell me. Looking at Microsoft, they seem to be in a little bit better shape in the context of their balance sheet, beating most expectations across the board. Their operating income rose 10% from 20 billion to 22 billion. When we look beneath the surface though, we see that Microsoft's share buybacks decreased. I think the big thing I'm getting at here is that margins are starting to slip. They're slashing costs however they can. Specifically for Google, they're reducing purchases of property and equipment, purchases of marketable securities, and insurances of debt. Looking at Microsoft, they're reducing stock buybacks, acquisitions of companies, net cash acquired, and purchases of intangible and other assets. That's really what I got. They're doing their best to slash costs, and they're honestly doing a really good job at this time. I think it's more the focus on the obvious that they're starting to roll over as they run out of things to cut, and their bottom line begins to get affected as the recession takes full force. All right, folks, moving to technical analysis. Excuse me if I'm slurring my words. I just finished a pint of wild turkey after today's trading day. Starting with the QQQ, looking at the daily perspective, we pulled back to the dreaded level of 313. This has acted as support and resistance multiple times. Most notably, if we look back at August of last year, this is where we saw the reversal of the bear market rally. Looking at the 15-minute chart, we broke the level of 313 just prior to the release of Microsoft and Amazon's earnings. After hours, we saw the algos pump, 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 baby, getting stuck at the level of 313 again. The bull's best hope is busting through this level in after hours. If we see another gap higher tomorrow and don't break this level, I'd be extremely careful chasing the rally. The 4-hour chart, what's that telling us? It's looking like the MACD is curling back over into bullish momentum. That's good. This, in combination with the curling into bearish momentum for the VIX, is a really good sign for the NASDAQ. But if we're not going to break this area of resistance after 2 days of quote-unquote blowout earnings, do we really have the buyers at this level? Bears are hungry right now. We'll see how it plays out. Taking a deeper dive into the VIX. The VIX has been sitting at lows for a while now. The debate is whether it's artificially low due to the zero DTE options trading, or if it's naturally low due to the calm markets, zero geopolitical tensions, and a competent, intelligent Washington, or the Fed lowering rates aggressively. Over the last 2 days, we've finally seen hedging take place as the VIX exploded to its zone of resistance or support, depending on the way you look at it. Moving on to gold, the timid, the wise guy in the room. Gold on the daily chart, strong moves recently. But is it time to dive in? We just have had a massive move. We have Dixie pressure building as the 0.25 basis point rate hike is looking more and more likely at the next Fed meeting. Gold just reached previous highs from last year and is now consolidating. MACD is in bearish momentum. The price appears to be contracting, but contraction leads to expansion. This could be the upside, it could be to the downside. Realistically, in the long run, gold is a great buy. But don't dive in when the risk to reward is so high. Wait for the pullback. We will get our chance. Oil, down big today after not moving much recently, landing hard just above strong support at 73.50. This could be due to recession fears as earnings are coming out and people are finally starting to read between the lines. Bitcoin, the big bubble. Michael Schiff's not going to like us for this one, but Bitcoin is showing some weakness as it does a false breakout and stays at support around 2750. The longer it stays at the support, the more likely it is to slide back to the 2500 range where it will probably find some buyers.